If we don't get stimulus till February, March, if it doesn't happen until after the election, is this something that could drain enough out of the economy or not refuel it enough that it derails the recovery that's underway?
It certainly creates a downside risk. One of the unusual things about this downturn is normally when you have a severe downturn, household income falls off and consumer spending falls off, and then you get a sort of a downward cycle. We didn't have that here, in that even though we had a severe downturn in the second quarter, household income stayed relatively steady and consumer spending stayed strong. It shifted, but it stayed strong. And that's why for the year, the U.S. is going to wind up having a less serious contraction than other countries. We believe now, and we've been getting more optimistic over the last couple of weeks, that U.S. GDP will contract by something like 2.5% for the year. That is a much better performance than other countries, and a big reason for that is this fiscal relief, unemployment benefits, income relief. And so right now, people are still spending, but they're doing it out of savings from the benefits they've received. And I think people have in their minds that something's going to get approved at some point. If that were to not happen at all, and people got that idea, I think you'd see it show up in consumer spending, and would start to have, the danger is we'd start to have the fall off we normally see in a downturn, and that may lead to other negative effects that will meaningfully slow the recovery. And that's what we're watching for and I'm concerned about.
Is it possible that, as one Fed official said, one of your colleagues, that there really is enough stimulus that when you made your Federal Reserve plans, when the CARES Act was passed, when all the stimulus started at the beginning of the year in March, people were assuming an even bigger downturn? As you said, it isn't as bad, and 10 to 14% of GDP in spending was allocated. Now it's not as weak. We're still going to spend the same amount of money. Is it possible that we're maybe a little too worried about this and the economy can keep on the same track you're talking about?
I mean, my own judgment, and this is one of these things we'll know better in hindsight, how long the relief lasted. I would guess we're going to need some additional relief at some point here. Can we go on for a while without additional fiscal stimulus? We could. Could we go on indefinitely? I would guess you're going to see a weaker recovery if that were to happen. That'd be my judgment and our judgment here at the Dallas Fed.
You know, let's say there's no stimulus for several months, and the economy does need some more help, or it seems like the prudent thing to do. What about bond purchases? That was a subject of debate apparently at the last Fed meeting in the middle of September. You can't cut rates more. That's the logic. If you have to do something, bond traders are saying the Fed's going to be forced to buy more bonds in much larger quantities potentially. What do you see?
Yeah, I don't see that right now. And here's the issue. Of all the issues facing the U.S. economy, one of the problems we're having is not that rates are too high. Term rates along the curve are historically low. And bond buying is done in order to further depress term rates, and at the moment, I don't see that as the issue or a significant issue. It may become one later, but it isn't one right now. The problem is this: the Fed has a lot of tools, and we have more things we can do, but our tools primarily ease financial conditions. They make it easier to borrow money. Our tools are not well suited when you have an income loss, and we need to make up an income loss. And there's two areas. There's individuals that have lost their jobs who've lost income, and there's states and municipalities that can borrow and are using the private markets and are borrowing. The problem is they have a fiscal hole, and they need to balance their budget, and they need to cut expenses if they don't get any relief, because they have a fiscal hole. Borrowing more money is not going to solve their problem either. So I think the Fed can do more, and I'm sure we will look at all our options, but those aren't substitutes for fiscal policy.
So how about shifting the composition of the bond purchases that are currently in place to more longer dated bonds?
Again, I would say if you look at the 10-year and the 30-year, could they be lower? Yes. Is it an impediment to business operations, investment, mortgage rates are historically low. I just think we have to recognize that that we're already buying a significant amount of bonds as it is, and I'd be skeptical about the benefits of doing more myself.
Just want to ask another quick question on this debate that's going on. The Fed was apparently you're going to be talking about this even more seriously at the November meeting. Esther George said the Fed needs to give details on guidance when it comes to the Fed's intentions with regard to bond purchases to ensure effectiveness, transparency, accountability. So what's going on here? What's the question you guys are grappling with?
I'll speak for myself on that. I think we're buying still a substantial amount of bonds every month, both treasuries and mortgage-backed securities. I think we could say more about what our plans are going forward, but my own view is I right now would be hesitant to see us doing more in that area because I don't see the benefits. Okay. I could see how it would further add fuel to the financial markets. I'm more skeptical how much it would help the real economy.
Got to ask you another question that really struck me coming out of the minutes, because the minutes said that the new outcome-based forward guidance is not an unconditional commitment to a particular path. I thought you guys just said that you dissented against it, that the Fed won't be moving rates until inflation is at 2% and moving higher and you're at maximum employment. Now it sounds like there's some flexibility there, Rob. Was this a compromise that had to be reached for you guys to put out this statement and have the new forward guidance? It really seems vague and not clear still, even though you've said recently, no, there's plenty of clarity on this new framework.
Well, I think there's plenty of clarity for the next 2.5, 3 years on the path of rates. I think there's going to have to be judgments made on what we do beyond the next 2.5, 3 years. But I think it's going to take us that long to weather the pandemic and get the economy back on track. And I think until we've done that, rates are likely to stay where they are. But there's another paragraph. So there's the paragraph with the forward guidance or enhanced forward guidance. Then there's another paragraph after it, which is worth reading, which talks about financial stability and a whole range of other issues going on in the economy that we're going to be cognizant of. And my own view is we should be cognizant of. So I think, yes, and there will always be people who say they want more clarity, they want more transparency. But I'm a business person. I've been watching the Fed for most of my adult life. We've got pretty good visibility on what the path of rates is for the next few years. There may be some debates about asset purchases, but I think there's decent visibility there also. And I think you want the Fed to have the ability to use its judgment and adapt to overall conditions.
Why is 2% so important? You just mentioned the financial risk. That was part of your dissent. For what, 8 years when inflation couldn't get to 2% and stay there, unemployment got down to a 50-year low, GDP was growing near trend. Does it really matter that much to get to 2%, especially if you're going to take the risk of financial risk on your plate as you do so?
Well, to me, and I've said this, I'm much more interested in financial stability. So we don't want deflation, and we don't want, on the one hand, and we don't want inflation running away from us. What ideally you want is financial stability, so people can go out and have, with confidence, buy goods, businesses can transact, and not worry that we're going to either have an extreme deflation or inflation. I think it's wise for us, and I support us re-anchoring inflation expectations at 2%. But for me, the 2% by itself is not magical. It's indicative of price stability, and I think that's what we're shooting for.
The virus, Fed, and you too. I mean, you've been saying, a lot of you guys have been saying this is the top of the list. If you want to ask me where things are going, it's the virus. Where do you see the virus now? You watch it very closely. You have contacts yourself, scientific, you know, epidemiologists, everything. In a nutshell, where are we?
I would say we're at a kind of an uncomfortably high level of virus right now. And we're heading into the winter. We're heading into flu season. And so most of the epidemiologists, infectious disease experts I talk to are worried that we're starting the fall at an uncomfortably high level. And their worry is at this high level, if we don't really show discipline in mask wearing and healthcare protocols that we could get in an unmanageable situation in some locations. Obviously, I'm hopeful about a vaccine. I'm hopeful of better therapeutics, but I think we're going to have to really be disciplined in the meantime, and probably for a good part even of the time after we get a vaccine, to wear a mask, follow the protocols, and respect this virus and respect each other.
Does the Dallas Fed Mobility and Engagement Index that you guys came up with this year look so interesting? It tracks cell phone usage to get a gauge of the economy and how it's being affected by the virus. Right now, what's it telling you?
It tells me that we're kind of, it's consistent with the virus. We're kind of stalling out in the low to mid 30s. And so just to give people an idea, 0 is the best possible score. That's the level of engagement in February. 100 is the worst. That's what happened in April. And we've recovered quite a bit of the way, but we're hanging around in the 30s. We're showing a little bit of improvement, but I would say the improvement is decelerating. And you kind of see that in the claims numbers today, that we're getting better, but the rate of improvement is slowing. And I think the incidence of the virus is probably a big factor as to why we're improving, but the rate of improvement stalling out a bit.
Main Street Lending Facility, you commented on that today. You said that it does need to have changes, like easing credit requirements, but that's up to Treasury and Congress. So can the Fed, is there nothing the Fed can do to fix what's holding it back from being a stronger source of lending and stimulus, especially if we may have to wait 4 or 5 months to get more from Congress?
I mean, I would listen, the other 13.3 programs, Fed programs on the public markets, I think are working very well, including the municipal program, where there's plenty of borrowing in the private market, and the Fed backstop is encouraging that and encourage flow of funds into those markets. And I think it's good the Fed isn't being used as much, but the backstop is serving the purpose. On Main Street and on PPP, in talking to small businesses, we could use more, another round of PPP would probably be useful. And on the Main Street program, it's not that mid-sized and small businesses aren't borrowing from their banks, but the banks are deciding. I was just talking to a banker today, indicative, we're lending to those companies. We just rather not do it through the Main Street program because we want to keep a higher than 5% share of the loan. We like the loan. And on loans we don't want to keep, we're not going to use Main Street because we don't even want to keep 5% of the loan. So you're seeing that you're going to need an ease in the financial terms of that, and maybe in the refinancing terms. But it's not like companies are not borrowing. Just bankers and companies are doing transactions. The problem is for those companies who would want to use Main Street, they're usually weaker credits. Okay. And that's the dilemma. There's no getting around. You need some credit softening. That means greater loan losses.
I want to wrap up with a kind of a big picture question. Modern monetary theory, Fed buying bonds. You said you'd be more inclined to buy bonds if yields were rising. And of course, you don't want yields to rise too much because the government has to have someone buy their bonds. That's how you finance the debt. That's what seems like a part of modern monetary theory. Has the Fed been sort of dragged by circumstances into doing just that?
Well, so this is why it's very important to differentiate what do you do in a crisis and what do you do post-crisis. And I think it's very important to delineate. In the middle of a crisis, we do 13.3 programs. They need to lapse as the crisis wanes. We've got bond buying that we're doing for a number of reasons. But when the crisis starts to lapse and we've weathered it, I personally would be an advocate of withdrawing these programs. The 13.3 programs need to lapse. The bond buying needs to curtail. The Fed balance sheet growth needs to curtail. I don't think it's healthy for the markets to be addicted or too reliant on Fed presence. I don't think it's a healthy thing. I think it engenders fragilities. And I think it's always wise to keep that in mind. And I will be actively keeping that in mind as we go through this.